All right, welcome to Better Call Saul, where Rachael Real and I talk to Saul Klein. Hey Saul, how are you?
I'm doing good. How you doing, Jennifer?
Good.
Rachel?
Rachel, how you doing?
Fantastic. I'm ready for this one. This is gonna be good stuff.
This is going
Good
to be
stuff.
definitely be a good one. So we've been hearing a lot of like legislation and things come through and a lot of tax bills, and it's a lot to digest. So we're going to take these in little bite-sized pieces and talk about them. So Saul, we were talking earlier, it does have a tendency to be political, but can you create some perspective for us on just like tax bills around housing in general? And then we can get into one.
Yeah, so it's important to understand when we're talking about taxes and we're talking about tax policy in general, that there's a purpose behind it. It's not just that the government decides they're going to collect revenue and then how do they get
To take
revenue
our
from
money, Saul.
it,
We
right?
all
Yeah,
know
they want
that.
is they like figure out first. So the tax law is there for social and economic engineering.
Okay.
That's what it's for. If the government has a good cause, like housing for everybody,
Mm-hmm.
or housing for people who are less fortunate, make a little bit less money, right?
Mm-hmm.
The government will say, hey, if you build this kind of housing, we'll give you an incentive. If
Mm-hmm.
you do this, if you build houses, we'll give you an incentive. Now, not only does it build the housing, it creates economic activity.
Right.
Economic activity puts more people to work. More people working creates more revenue. So you get more people working, more. So the whole thing works. And what does the government do? It's like they kick it everyone. They give it a little benefit everyone, right? They create
Right.
this. And so when we
Well, that's
talk
what they're
about
doing with
taxes,
interest rates too. They do that.
yeah.
The Feds do it
Well,
with interest rates.
so when we talk about taxes, it's really, you got to think of providing housing. And
Okay.
it's about giving the incentives to allow us to create jobs and to create housing.
Yes.
And so and it's been, I got into the real estate business in the 70s, and we were in a recession in the end of the 1970s. And so Ronald Reagan was elected, and he came in with something called the Economic Recovery Tax Act. And it was amazing the things it did, how preferential it was to real estate. And I could go over the real estate benefits with you, but I will tell you, I was a real estate broker at the time. It changed my business. And it changed my business because I decided I'm going to learn everything I can about this, because my clients either benefit or are hurt. Not
Yeah.
me, but me too, but my clients are either they're benefit or hurt by these laws. Who am I to say it's good? I got to look at my clients. And so the Economic Recovery Tax Act in 1980 was a great opening for me. And I
Mm-hmm.
think today for anybody, the same thing, because this is expertise you should gain as a real estate professional. You should know what these tax changes are. You should know how they affect your clients. Not that you're going to give them tax advice, but you
Right.
need to know this. This is part of your profession. And if you know it and your competitor doesn't, that's a differentiator. I built a business
Yeah.
around doing that because other realtors were either too lazy or didn't want to take the time or didn't think it was important. But my clients that were buying and selling real estate, they wanted to know, how much tax do I pay on this when I sell
Right.
it? Matter of fact, sometimes before they even bought it, they wanted to look at the tax consequences at the end. And
Right.
so remember, these laws are designed to stimulate and to achieve certain objectives of the government. So what the government is trying to do, what we're seeing now, the proposals in front of us now are destructive to housing. So if we're seeing proposals that are destructive to housing, this isn't political. I've been on this side of the fence and all of us who are realtors have, we call it the Realtor Party. It's not the
Yeah.
Democrat Party. It's not the Republican Party. It's the Realtor Party. And if people support realtor issues, real estate issues, then we're with them. It
Yeah.
doesn't matter the party.
Right.
And so right now there is a threat to something that I'm very passionate about. It's being able to own and benefit real property. Arguments are being made in social media by people that don't have a clue what's going on. They can't even tell you what basis is, but they'll argue with you about elevated basis.
Right.
And right. And so we're looking at these things and we're having to try to explain it to people that don't have a fundamental basis for understanding. So social media, if you haven't read The Hype Machine, social media hurts in
Yeah.
this case, right?
Well, it's kind of hard to understand too, because a lot of these, like you're trying to read through it and it's confusing and so like that's the point of like these videos is let's kind of try to figure out what it's saying and see what we really think, you know? Okay, so let's talk about the 1031. So the what I thought it was is that they were saying that they're going to eliminate the ability to do 1031s.
Well, so these are proposals.
Okay.
So we don't know where they're going to end up, right? And so this is still a back and forth, and you'll see changes, and we've got a great lobbying team at NAR. They are the very best at what they do. And again, in social media, you'll hear people and see people making comments that don't know these people and what they do,
Yeah.
but we have a fantastic team working
And that's
for us.
RPAC, yes.
And that's our
So I think-
NAR lobbyists,
Yeah, I think
funded
we
partially
need
by
to,
RPAC.
yeah, we need to like remind people that RPACs are the RPAC, when we contribute to them and they're lobbying for us as real estate agents, as realtors, they have really helped us maintain our ability to make money in the way that we do and make the amount of money that we're able to make as a result of this job. So supporting RPAC is critical. Regardless of what you think about the NAR, this is like sort of a separate entity housed under NAR, and they are critical. Without them, our world would be very different.
Yeah, and they're experts at all these issues.
Yeah, I mean, they're
lobbyists. You want experts arguing on behalf of what is the membership and their customers, right? So they're really great people. They do a great job. So this is right now it's in the process of negotiation. So when we look at this, so what the proposal at this point, the latest one I've seen.
What a 1031 is first for people.
So so what 1031, that's great. 1031 is a section in the Internal Revenue Code. What's the Internal Revenue Code? Well, so I can go through that.
Take all our
there's
money.
a big section of what's the Internal Revenue Code, and it's section 1031, and it allows, based on certain very stringent rules that you have to follow exactly. If you don't, you're going to lose this tax benefit.
I know. I've done two of them in the last few
so you
years.
have to do this exactly.
Yeah.
And if you do it exactly, it allows you to take the gain out of one property and put it into another one without paying any tax. So typically you buy a property, you sell it, you pay tax, you got a little bit left, you buy another one. You sell it, you pay tax, you got a little bit left. This allows you, basically, it's an interest-free loan from the government. You still owe the taxes.
Mm-hmm.
You just don't have to pay them right now. And it's rolled, your gain is rolled into your new property. How is it rolled into your property? By decreasing the basis of the newly acquired property. And so that's what you do. And if you start with a house, you can get a duplex, a fourplex, and this is how a lot of people have built family wealth. And there's nothing wrong with family wealth. Right. You should be able to pass your family wealth on to your children.
Yeah.
And so you build it this way. And the government now, in doing this, people can build wealth in buying bigger properties. People are put to work. It creates economic activity.
But you don't have to buy bigger ones, because I went from a 4-family to 2 single families, and that was okay.
Yeah. So when I say bigger, so here's the rule: is you have to trade up in equity and value. Yeah. And when they say like kind property, like for like simply means real estate for real estate. I could exchange a commercial shopping center for an apartment building, as long as the purpose is rental, right, or is income producing property.
Right.
So an exchange is a section in the tax law. It's not a loophole. It's carved out because the government want to incentivize people to create wealth for themselves and to own property, and specifically in the residential area, which creates housing. So an exchange allows you to build your estate with pre-tax dollars. And that's a great advantage.
So what would be the other side of it? Why would there be some people who want to get rid of it?
Well, number one, they don't understand the economic benefits that it brings. Mm-hmm. They might feel that it rewards the wealthy, but if you look at the statistics, that's not really the case. It rewards big corporations. So based on false evidence, they might be against it because it allows people to build estates and it helps them pass it on to their families. And to some people, that's racist. That you shouldn't be, there's some people, you shouldn't be allowed to pass this on because you were allowed to buy that property in the first place. And we were not. We were redlined out of it. We could not create wealth on our own. And you were lucky you got to. And now these laws are letting you build that advantage even greater over me. That is so racist. I'm going to fight against that. So I'm just saying there are passionate voices out there, right, that believe that, and they're passionate and they believe what they believe, and they're entitled to that. So you ask me why, there are many reasons why.
I guess like if I'm thinking like if we didn't have the 1031, okay. So I mean I've just actually today finished one of them. So if I didn't have that, would I buy the properties that I bought with the 10? Probably no, I wouldn't have.
You
So then
wouldn't
you're,
probably have the resources.
what's that?
You wouldn't have the resources.
Right, exactly.
So what's the proposal? The proposal is not to eliminate it.
Right.
The proposal is to limit the amount of gain you can defer.
Oh, I gotcha. Ew.
Now, that is eliminating, that's eliminating the benefit,
Yeah.
because
That's the whole point of the benefit.
there will be inflation.
Okay.
And as there's inflation, the value of that benefit will decrease, right? So,
Okay.
so that there is no move to eliminate it, but at the same time, then only allowing 500,000. What if you've been doing this for 20 years?
Yeah.
And you've got
Right.
3 million, and again, you're going to have people argue, well, you shouldn't have 3 million. That's a different argument.
Yeah.
And we're having, that's the problem, is we're mixing these arguments.
Yeah.
And social media allows for the mixing of the arguments, and it really shouldn't be, right? Because then the points are completely separated and we're not going to get anywhere.
Right. Exactly.
So,
Well, plus like if we eliminate the gain, you're thinking that then
the tax
you're
on the
also
gain.
eliminating housing.
Well, if we eliminate the tax benefit on the gain, we're taking away incentives to create housing.
Correct. Because
We're
it wouldn't otherwise be created, is what you're thinking.
To a degree. I mean, we can go through this, but certain things certainly are done for the tax advantage that's afforded.
Of course,
right?
People love incentives.
Right. And so when the government wants to get the people to do what it wants, then it passes tax laws. But now we should look at this in reverse. We should look at the proposals coming from the government and say, what are they really trying to do to us?
Right.
Based on these proposals, because that's the purpose of the tax law. It is revenue generating, but that's not the, people say it's the primary reason. There's an argument for that. But if that's really the case, then how come we owe trillions and trillions and trillions of dollars? Obviously, it's not about the money.
Yeah.
Because we just spend the money. We don't really care whether we take it in or not. There's no way we're going to take in enough to cover all that money that we've spent in the past. So it's not just about revenue.
Right.
Although that's another thing. People will make the argument that it increases revenue. Well, that's a shallow argument.
Yeah. I don't know. It's a
big deal, right? It's a big deal.
So I think like if we removed, let's say we removed all the tax benefits of owning any home, whether it's an investment property or, any home, like
primary residence, any ownership. Okay.
Yeah, exactly. Like that, because I'm always like, I think like, what if it went to the extreme, right? So if you removed all that, what do you think would happen?
Well, I don't know, but here's the argument. People will say, well, interest deduction, right? So that interest deduction, why is there an interest deduction? You see, anytime the government gives you a deduction, they think that's an expense to the government. So that's an expense. Why do they give you an interest deduction? Because they want to what? Encourage people to buy housing. Now you go to Canada, at least last time I was there, they didn't allow for mortgage interest deduction. And yet there's a housing market, right? So is it as robust as ours? I don't know. I haven't made those comparisons. Would there still be people without shelter? So people would probably still want to own.
Yeah.
Right. Yeah, I don't think if you removed all of those, if you removed every benefit to the people owning their primary residence, I don't know that it would have all that much effect on that. Everybody's got to live somewhere, and I'd rather pay for it and build equity myself rather than pay someone else's mortgage.
And here's a great argument that's going on in the country, though, or used to went on. It's going to go on again. It's the SALT argument, right? It's the deductibility of interest on your home and your property taxes.
Yeah.
And so years ago, in the 80s, they restricted the interest deduction on your home. And then the dollar and the inflation, and then the ratcheting down as you paid it off, you ratcheted down the amount you could actually write off. But there were restrictions placed on being able to write off that interest. And that amount gets low. And then the most recent one, they limited it like 500,000, right? Loans of what do you know the amount, Rachel? What's the loan amount that you can write interest you can write off in your personal residence? On loans
it wasn't around 500,000.
Something around 500,000.
Yeah.
Right. So you can write, before that, it was $1 million. Was $1.1 million. And then, you're sitting in the middle of the country and maybe you didn't pay $1.1 million for your house. And you're thinking to yourself, you're a realtor, and you're thinking to yourself, who borrows $1 million to buy a house? And the answer is people who live in California,
right? Exactly.
People who live in New York, or people who live in. And so what the government was actually doing by having an unlimited amount was subsidizing certain states. Kind of, that's what people, now the people in the state said, no, that's not really the case, but the people in the other places, so they passed this limitation, right? And they brought that down to like the 500,000, which is more reasonable for the population in general, right?
But like when they brought that down, like how did that affect? Do we know how that? Yeah.
Well, again,
looks like the current deduction is 750,000 for married. Yeah.
They brought it if you're married, right? So they brought it down. And what that meant for a lot of people in California is it changed the deductibility, changed their federal tax picture. To what degree individually, I don't know, but it changed their federal tax.
And then they changed it so they had to pay more.
They're going to have to pay more, and that's what happened. They had to pay more, and so there
single filers and married couples filing jointly goes up to 750. If you're single, if you're a joint filer, head of household, you can separately deduct up to 375.
But here's the thing about rental property and like a 1031 and all this stuff. There's more than one way to sell a house, right? Like you don't just have to sell it outright. So if this passes and there's like a limit and the limit does not make sense for the person that's selling, they're going to come up with a different way to sell it.
Yeah, so there will be different solutions that could result in different types of marketplaces.
Yeah. With
different effects and different outcomes that probably from a housing perspective won't be as good as the current housing situation, right? So again, and these things they don't happen overnight. It takes time. Remember before the 80s, it doesn't matter how big your mortgage was, you could write the interest off. And then they reduced it to $1.1 million, and then they reduced it to 750, and there's an unfairness, and it takes time, and then this is politics, because you got states with senators and Congress people that are say, wait a minute, we think that people should be able to write off $3 million loans, and then you got people who live in states that don't have people living in homes like that say that's not fair to us, right? And you end up with a compromise, right? And so that's another reason we have these things. And so to go back now and just to say, well, this is not right, we should change it.
Yeah.
This is not right, we should change it. There was a whole lot of time, effort, thought, money into where we are today.
Right.
And it's not that easily unwound. And is that the best thing to do? And unfortunately, again, for me, the big rub is we're having conversations about it when we're not using the same language. When somebody's talking Greek and somebody's talking French.
Right.
Right?
Yeah, we don't know what we're talking about. So the current proposal is to make it so that you can only take a maximum amount of
defer.
the gain.
You can only defer. Remember, so when you dispose of an asset, you have a capital gain.
Right.
The capital gain, 3 types of capital gain: realized gain, recognized gain, and deferred gain.
Okay.
Typically, I sell it, I get a gain, it's recognized. The government says, we recognize that, pay us taxes on it. Sometimes if you play by the rules, the government says, you sold that, we recognize that gain, but we see that gain, but we're only going to recognize this much, and we're going to allow you to defer. Doesn't mean you don't ever have to pay it. It's a misnomer to call 1031 a tax-free exchange, because it's not a tax-free exchange. It's a tax-deferred exchange. And it stimulates economic activity. And again, the big arguments for doing this is that it's a benefit for the wealthy, and that's not really true.
Not true. Yeah.
So you got to really play with that one. That's the racist thing. You really got to play with that benefits the wealthy thing to make that argument stick. And some people make that argument, right? And the other is it generates revenue. Well, at what cost? How much revenue do you give up in economic activity to generate the revenue, right? The real estate commissions that could have been, because, right, that we could have paid taxes on because of it. So it's something that's worth protecting. And here's what I say to people who are against it: just learn about it and then whatever, right?
Yeah.
Another big issue I think people need to consider, can we move on from 1031 quickly? This is a real important one. And that is, people were talking about stepped up basis. No longer does it look like removal of stepped up basis is the issue. The issue is recognizing the gain on the decedent at the time of death.
Okay.
That's a bigger issue than elevated, right? And so so for elevated, to understand elevated basis, you have to understand basis. So what's the basis? It's the way you calculate capital gain is you take what you sell it for minus the selling expenses, you subtract the basis, and you get the capital gain. That's the profit. That's what you pay tax on.
The profit.
If you can have a higher basis,
you have
artificially somehow, it's going to reduce your gain. It's going to reduce.
Exactly.
So you want a higher basis. So what is the basis? It's this. It's a formula. It's the original cost plus the capital improvements minus the allowable depreciation. So that's what it is. It's original cost plus capital improvements minus allowable depreciation. Over the years, your basis will decrease as you depreciate. If you improve it, your basis goes back up. So let's say I owned a property and I've owned it for 40 years. And I bought my share for $45,000, and my share today, and my basis is $45,000.
Okay.
And it's worth, my share today is worth $1 million.
Okay.
If I died, under current law, my estate gets stepped up basis. So what happens is, if you pass your property on to your heirs, when you die, the basis that they have moves up to fair market value at death. And if they sell it at death and the basis is the fair market value, the gain is zero.
That makes more sense. Yeah.
That's what you want, elevated basis. Now,
right.
So that's one way to elevate basis, die. Another, right? So
perfectly good way to handle it.
People would come to me and they say, hey, I want to give this property to my kids. I bought it 50 years ago. I want to give it to my kids. I don't give it to your kids. Your basis is like zero.
Yeah.
You give it to your kids. So the basis of a gift is the donor's basis or the fair market value, whichever is less.
So what's the proposal for the bill to?
So I understand. So basis, and there are different ways to establish basis. So now the bill they were talking about eliminating stepped up basis.
Oh, so to keep
that's what they were talking about. So now let's say I bought a property for 100, and then when I die, it's worth $1 million. My heirs get it. Their basis is $1 million.
Yeah.
But the government is saying,
no.
Make the heirs have the $100,000 basis.
Yeah, but honestly, Saul, though, if people were worried about that, it would stimulate them to sell.
Not necessarily. And why is selling isn't necessarily the right thing if you're trying to build an estate, right? Think about this. So think about this basis, right? So this basis, here's the proposal now.
Okay.
Forget elevated basis. We'll let you keep the low basis, but we're going to tax the gain, unrecognized, unrealized. We're going to tax the unrealized gain at death. So now here's what happens. You bought it for 100, you die, it's worth $1 million.
Yeah. They tax
your heirs own it.
Yeah.
The government says, okay, it's 100, basis is 100,000 and 900,000, 30% tax rate. A state, you owe $300,000. The state said, we don't have any money. They say, too bad, sell the property to pay us. So by recognizing the gain at death, you're going to force estates to liquidate. Yeah, I guess, Jennifer, you're going to have more sales.
I was right. It would force people to sell, or they would sell.
But that's a terrible thing, right? And so that's really
they wouldn't stay in their house.
Distasteful thing to people to think that you have to sell your parents' home because you can't pay the taxes on it.
Yeah, that doesn't seem to. That doesn't leave a warm fuzzy for you.
But that's the proposal. So now when you hear the elevated basis proposal, It's been substituted.
Mhm.
And then remember that this is in flux, that this is a proposal, that the administration made a proposal. The House and the Senate Democrats have one idea. The House and Senate Republicans have another idea. And so these things are being going back and forth, but
Right.
it's
They're
on the floor.
flushing out all the options and flushing out all the ways they could compromise and make it something that both
Make
sides
it
would be
work.
happy with. Right.
So then let me ask you this. If we're a real estate agent that's interested in like learning more about this, interested in like figuring out how we can help. I mean, I understand that part of it is donating to RPAC. Where's the best resource to like, besides our videos, obviously?
Here, I just got this one today. Let's see if I can find it on my phone. I got this text from NAR
Yeah.
that said, text 30644 and then write the word action. And they'll send you Realtor Party mobile alerts.
Oh, interesting.
Right. So I just signed up for it today, right? Because I sent an email to my buddy Bob Goldberg, old friend of mine, and I asked Bob, I want Q&A, I want the latest stuff. And he put me right in touch with the people, with the staff there. And so I've already had a couple email exchanges, because we need to get this information out to people, and then they can make their own decisions.
Well, but I think it's good though to walk through it like we're doing and explaining it, because it's just a lot to read through, and like reading comprehension is tough.
Well, and then it's often not written in such a way that the regular Joes are going to understand it very well. There's a lot of technicality in there, so I think breaking it down in these ways is really helpful. I think it's also important to note that RPAC is there for agents, but they're also there to help fund and help government affairs departments that are within the local associations for private homeowner rights too. Mm-hmm. So supporting RPAC also supports governmental affairs, which supports private property owner rights too.
Which is our clients and us.
Exactly. So it all trickles down. So yes, it helps us, but it also by the trickle down effect helps our clients too. So that's huge.
Yeah,
I think it's one of the most important things that we can do as people who make a living around real estate is understand the tools that are there to help protect you and your clients.
Absolutely.
And when I say protect, it's not like people are intentionally out to get you. It's that they don't necessarily understand there are different interests. You have to have a voice somehow, or you're going to get stepped on. That's just the way it is. And we're very fortunate to have the voice that we have in RPAC, protecting it to the best of their ability. Sometimes I disagree with them, to the best of their ability, real property rights.
Yeah,
exactly. Yeah, I think that's huge.
Cool. Well, thanks for explaining that, Saul. And if people want to get a hold of you, they have questions, what's the best way to reach you?
Saul at bettercallsaul.com. We're relaunching the dataadvocate.com real soon. So all the stuff that we can figure out people need to know, we're going to post it there.
Perfect.
Awesome.
And then Rachel, if people have a referral in Chicago for you, what is the best way to get a hold of you?
Best way to reach me is by phone at 630-542-8688 or on Facebook at facebook.com/RachaelRealEstate or on Instagram at RRealEstate.
Awesome. Thanks, guys.
Great.
Thanks very much, Jen. Thanks, all.